Welcome to the Hard Money Show, where we talk about real estate, home loans, and media. It is a good day when we can get on the podcast and talk to you about up-to-date, relevant, and most importantly, entertaining information. Now, today is a solo podcast, but I do have a special guest today. Yes, I do. That is Yahoo finance anchor Julie Heyman. Now, I actually don't know Julie. She's not actually going to be here, but I saw a very interesting video put out by Yahoo, actually on TikTok. That's right. I watch some of my stuff on TikTok. I watch some of it on Instagram. I stay up to date on the market wherever I can get the information, and verify it for myself, obviously. But I thought this was really interesting, so I wanted you guys to take a listen, hear what I was hearing, and we're gonna jump in and we're gonna talk about it because ultimately, I think a lot of people are scared of where the market's at right now. We lived in a really cushy time for a while there, and I think this is really gonna kind of bring some stuff to light. So let's take a listen.
0.7% is what you're looking at now for a 30-year mortgage, according to Freddie Mac. That is the highest since July of 2007. Let's put this in perspective, folks. 6.7% is what people are paying on average for a 30-year mortgage right now. A year earlier, that number was less than half at 3.01%. So how does this translate in real terms? The Wall Street Journal citing a bank rate mortgage calculator to really bring it home for you. If you had bought a $500,000 house a year ago and put 20% down, you would be paying $208,000 in interest over the next 30 years. Now, if you buy that exact same house, you are going to be paying $529,000 in interest over the next 30 years. 208 versus 529,000 because of that increase we have seen in mortgage rates. 6.7.
So guys, this is really interesting, right? We're taking a look at this and we're trying to understand what's going on. I know there's some of you that are out there, you're looking to buy, maybe you're looking to sell, but ultimately, we're looking right now from that perspective of a buyer. And I know that there's people, it took you a long time to save that money, right? Maybe you had to go through multiple jobs. Maybe you had to gain multiple promotions. Maybe you got married and now you have two incomes. Whatever the case may be, I know that here in America, it can be extremely difficult to get on the housing ladder. And this is a prime example of this. And before we jump into why this is still a good time to buy and all of that stuff, which you're going to hear from every realtor out in the market, because ultimately they need you to buy a house, right? Your ability to buy a house is what's going to help them get money to pay their bills, for possibly them to buy a house or for them to live their lives and support their families. So I understand the need from the realtor's perspective to find a way to argue that this is a good time to buy. I've seen a lot of stuff come out from that, but from a loan officer side, I always try to approach these sort of things from, where does your what are your financial goals, right? Where are you currently at? What can we get you into? But ultimately, what do you want your life to look like over the next 30 years that you're going to be owning this home? And maybe that's not my, responsibility to look after your finances and your goals. But ultimately, I think that there's a responsibility held on this position as a loan officer to provide as much information and do as much coaching as possible. And, I think the stats stand for where they are. I think there's a lot that, especially with millennials, I believe there was a stat that came out that said nearly half of millennials that purchased homes regretted buying their home. Now, is that possibly that they just realize that they don't, there's a big thing going right now culturally where, people don't want to be tied down, essentially. It's really the best way to put it, right? There's this whole kind of adventure culture that's coming up, and, we want to live in a van or we want to rent because that'll allow us to leave whenever we want, travel the world, experience life. And It's funny because I was just rewatching Mad Men. There's obviously, I think, a lot of problematic things with Mad Men that a lot of people can be upset about, but I'm a marketing guy, right? I've always enjoyed that. And so I was like, you know what? I'm going to rewatch this show for the advertisement to see, what they do, how they're inspired, things like that. I think there's always a little bit of truth that you can take from these sort of things. And I was watching it. There's this episode with this. I want to say it was in the 20s. I just kind of did some of the math in my head from, when Mad Men is taking place. And they did a cut back to when Don Draper was a young kid. And I believe that it was the 20s. It was around the Great Depression. And, there's essentially a traveling, bum, or he called himself a rails gentleman. But the reason I like kind of correlated back, because he was explaining that he's not a bum. And what I mean by that, he's not just like a guy that stays in one place and he's just like asking for food and handouts. He travels the railroad because his big thing is experience, right? He had a family, he had a job, he had a mortgage. He just one day he packed up and he left. And, he wanted to experience life. He felt stagnant. And obviously, there's a lot to be said about just abandoning your family. But ultimately, I think the sentiment is the same from, what he was saying to, I think, how a lot of millennials and younger generations are feeling about owning a home, right? They feel like they're tied to a place. They feel like it can be, overwhelming. But I think ultimately, when I look at it and when I look at what's happening in the market, I think what most people are upset about is that they don't realize that owning a home actually costs more than just what their loan officer is telling them, right? Because that stuff doesn't end up in, in your monthly bills or reports or anything when you're looking to buy this house. Now, is it fair to say that, as a adult making a large purchase, that you should understand what you're getting into? Sure, that's fair. But ultimately, buying a home can be extremely confusing, can be very scary, and you're putting your trust into somebody to guide you, to make you feel like this is something that you can understand, but also that you're like not getting screwed over on. And that's totally understandable, right? But it's kind of the same thing of buying a car, right? When you buy your car, and if you finance it, the amount that they're putting in there, they're not also putting in how much you have to pay for gas a month and how much you have to pay for new tires and for oil changes and all of that. And I think that it's those things that are on the house level that catch people off because they're so consumed with the purchase that they forget about these other things. And so when I'm doing this, I talk about it as it's called house poor. And what that means is you're buying so much of a home that you don't really have much else to do month to month because your money is so strapped in. Essentially, you're not going to have those extra funds until you get a raise, right? You're making more money, you're bringing more money into the household. So that can be really tough for people. And yeah, that would make you, feel pretty regretful and make you feel like maybe I shouldn't have bought a house. I know that for me personally, we kind of knew what we were getting into, but it doesn't really hit home until, those bills start coming. And especially for us, like I think our water bill comes every other month, not every month. And so it's, a little bit longer. It feels like a lot more because it only comes in that time. We have another bill, I think, that comes every 3 months. But when you break down that monthly cost, and now this is going to depend on where you live, what county, what state. We're talking about Sacramento, greater Sacramento for us, and California, obviously. But, it's not unreasonable to have $200 to $300 additional a month that you have that covers gas, electricity, sewage, water, trash. All of that stuff is part of your monthly income. So if you were already putting yourself in a position where you're leveraging everything you had to buy this house and pay for that monthly payment, and then all of a sudden you realize there's an additional $200 to $300. And this really does depend as well on when you buy your home. If you buy your home from essentially the end of September to October, all the way to April or May, then, it's not the same as buying in the summer. And what I mean by that is that our electric bill, because of the way that SMUD or PG&E out here, they sometimes triple or quadruple their rate cost during the summer. That essentially leads to bills that are a lot higher. Now, keep in mind that, I'm going to get into this in a second, but we put solar onto our home. So during the winter, our bills can sometimes be negative. And that's, ideally where you want to be if you're going to put the money to get solar. But during the summertime, it is a little over $100, meaning that if we didn't have solar, we would probably be paying almost $200 to $250 during those months for electricity. Now we have a pool. We have to, run our system longer at a higher RPM, and, we're home and we're hosting people and things like that. And that's why it all kind of adds up. But, it's that sort of stuff throughout the year that can make you regretful for buying a home, and make you feel like, so I think ultimately, that's where these surveys come back and people are unhappy with their purchases because they're not fully being informed. Now, for me, I feel obligated to really kind of go over this stuff because this is my career, right? This isn't just a one-off sale. This isn't just something to do. This is my, my life. And so it's important that ethically it's the right thing to do, but also, selfishly, I need repeat business. I need you to like your experience and recommend me to other people. And so I have an obligation just purely to my survival of doing what's best for you. And if I put you in a house and you're upset about it and you regret buying it, the likelihood of you recommending me to somebody else is probably not very high. Even if I did a good job on your loan, you're going to feel like, wow, well, why didn't they bring this up, right? Or man, I wish somebody would have brought this up. So I explained all this and I say, hey, keep in mind that, we're going off your gross income, not your net income. Keep in mind that, you have these other bills that are there and, other life stuff that comes up. But then the other big determining factor is you now own this home and you are currently responsible for everything that happens in that home. I know a lot of people, you might be lucky enough to be living with parents or things like that, relatives. But if you come from renting, some of that stuff is kind of built into your rate, right? They're going to handle fixing broken items, repairs and things like that. It's part of the understanding that you're renting. And this is obviously more prevalent if you're living in condos or apartments and things like that. But ultimately, that's kind of the responsibility on the owner. But when you own yourself, then everything falls on you. And so in the first 6 months, actually 4 months, 5 months that we owned this home, there was a big storm that came through Sacramento, 70 to 80 per hour winds. It blew off shingles from our roof. It blew over our entire fence, our largest portion of the fence that's facing the street, and people could have access to our pool. And, it was a really tough thing. And we had, as homeowners, had to figure out what we were going to do. We had to make that decision. And ultimately, we did as a household. But it's like if you just poured all your money into your house and then 4 months, 5 months later, you have to deal with your insurance companies and you have to put some money in yourself. That can be very stressful, very difficult, and you might not be able to do it right away, right? And so these sort of things lead to regret buying a home, and I totally understand that. But ultimately, I think if you have somebody that explains everything, you feel comfortable with that, you get into your home, that's where we are in this market, right? So we're going to start from that standpoint. We're going to start from the place where you feel comfortable with your home purchase, right? Now, I want to talk about the video. That's really what this is all about, is what she's talking about, right? Rates are a little over 6% right now. And a year ago or so, rates were at 3%. And that's where everybody's coming from. That's where the fear is. That's where the hesitation is. That's why the buying market has slowed. That's why property prices are starting to go down and more negotiations are starting to happen for buyers. But what does that look like, right, to you? And this is what we're talking about. And I think this is the exact conversation that we're having with people, because the 3% is so fresh in everybody's minds, right? 3%. That happens. And so they want to have that conversation. They want to know, it's going up, how much more. Now, one of the big arguing points that you're going to hear from realtors is that this rate that we're currently at, nationally at an over annual basis, that this is normal, right? 6%, 7% is where the market typically will sit in some sort of fluctuation from that. And you'll see people they'll say like the 80s rates were 12%, 16%, and that's supposed to convince you that you're supposed to buy right now, right? Perspective. Now, the other thing that you'll see is, what's better, 6% or 100%? And really what they're arguing is when you rent, you're paying 100% of that money to somebody else. When you own, you're only paying 6% to somebody else and the rest is going towards you. Now, that's not entirely true because you're paying principal, you're paying interest, you're paying taxes, you're paying insurance. And so that total cost for you out of pocket, not all of that is going towards paying your principal down. That's why it typically takes 13 to 15 years before you start to see more money going to your principal than it is to your interest. But ultimately, the sentiment is true, even if, it's 30%, and that means, you're paying 70% towards your principal or however we do that math. The idea is still the same, right? When you are renting, none of that money is going to your equity at all. And so they're using these different things to try to convince you that it's a good time to buy and to give you some perspective. That's really the key thing here, is perspective. Now, I know it's extremely difficult to know that some of your friends or family members got into a property at 3% and you're going to have to get into a property at 6%. But that's what the video kind of goes over to. What does that difference look like for you? Now, here at Orbit, where I work at Orbit Home Loans and Orbit Realty, we try to explain to people that it's very rare that if you are a financially sound person and you do what is necessary to continue to build wealth, generational wealth for your family, it's very rare that a real estate transaction is a one-time activity for you. Typically, people will either within that 30-year span, they will refinance. They might pull money out of their house. They might do a reverse mortgage if you're older. They might, take a second lien on the property. I mean, it's very rare that nothing else happens with this and you just go 30 years and you pay it off, right? So the number she's essentially saying is if you did nothing for 30 years at 3% versus 6%, it's essentially a $200,000 difference that you're paying over 30 years additional, right? A total cost of $500 and something thousand dollars that just goes to interest, $500,000. Now, we do explain that to people. I make sure that people understand that, right? That's why having a good credit score is so important. That's why having low debt to income is so important. That's why getting into this early and creating a roadmap so we can navigate this correctly makes the most sense. Now, keep in mind that 6% and those 3%, those are for good borrowers. Those are people that have 700s and above. Those are people that have low debt to income. Those are for people that have steady jobs and all of this sort of stuff, right? If you're a challenged borrower, you can expect those rates to be higher. So understand that, yes, that $500,000 is a lot, but that is something we're going to lay out for you. Now, that's only if you did nothing over the next 30 years and you kept that. But Nobody does that because rates will go back down. Traditionally, rates ebb and flow. It's like the ocean. They go up and they come down. They go up and they come down. And that's regulated about what's happening with the feds. That matters with our inflation. It has a lot to do with what our economy is doing, nationally and state and local counties. But ultimately, you can't always have the rates super high forever because people can't afford them. So they have to come down so people can buy and afford the home that they're going to get into. Now, keep in mind that the same thing happens when rates start to go back down and a lot of people start to buy, then property values start to go back up. So we start to have these different situations where people are trying to say, when's the best time to buy? Well, there's about 3 months to 4 months when rates are going down or rates are going up and property values are going down and property values are going up that would be ideally the best time because the market hasn't caught up on both of them yet. So one is more prevalent over the other. And a good example of this is when rates went down. There was a point where rates were at 2.5 to 3% and property values had gone up, but they hadn't skyrocketed yet. Those couple months would have been the best time to buy. But ultimately, nobody can predict what's going to happen, right? Maybe somebody who works at the feds or somebody that's high up in the government, they have better ways to understand what's going on. And I'm under no illusion that big corporate does play some role in this. But ultimately, for a normal consumer, a normal person at our level, we can't predict the market. And so, yes, there's sometimes is the best time, but ultimately what we're trying to find is the time that's right for you. And that's as honest as we can really be about it. When rates go back down, guess what we're going to do? We're going to call you and we're going to talk to you about refinancing because we want you to have a lower rate. We want your monthly payments to go down. We want the money that you're going to be paying overall in interest over the 30 years to go down. And that's what refinancing is for. And that's what happened when all the rates went down. There was a big refinance boom. And people who bought their houses who had rates that were anywhere from 8 to 4% refinanced their homes down to get into the 3s and 2s, right? And so this is the process, right? Don't feel discouraged. Don't feel like, you're getting the short end of the stick. This is just the way that sometimes buying a property works. And I think if you're a responsible buyer, for the most part, it'll all work out in the end, right? Especially when you consider that California is an equity state and that you're buying a property, one, because you're going to be your home, you're going to live there, you're putting money to what we would consider, your equity savings account versus just giving your money away to renting. There are things there, but ultimately we want to make sure you can afford that monthly payment. And yes, higher interest rates mean that you're paying more a month. That's how you end up paying more over the life of that loan. But we will do what we can and guide you to be in a better position later, right? I mean, that's where we want you to be. And so I understand that, you're out there, you might be frustrated because you just spent all this time. I understand people are getting priced out of the market. But I do think that it's important in videos like this one that came out from Yahoo. They're valuable tools to kind of look at what's happening and at least some basic math to understand. Now that, that difference in 3 to 6% is quite a bit monthly. It could be $500 to $800 more for kind of like the normal market price range where we're at. And so that's definitely something to consider. But just remember, rates will go down, and if you're lucky, they'll go down in the next, within the next 2 years, 5 years, and you'll be able to refinance, and now you're back at a good rate. And so it's something to think about. It's something to consider. I just wanted to jump on for us to have this conversation and hopefully bring some light to what's going on, right? I understand it's difficult, if you're in a position and you're working with realtors or looking what they're saying, be careful of who you work with. Understand that, this is a really tough time for realtors, for a lot of realtors anyway, and they need to get a sale. And I'm not saying that they're going to be unethical, but what I am saying is that, with hard times come tough decisions. And so be careful who you're working with. Work with a trusted company. Work with I personally think the best thing you do is to work with a brokerage that also has a loan side to it. So like we have our real estate side and we have our loan side, because that partnership is really unmatched. And it doesn't necessarily have to be my company, but definitely something to consider. But get informed, understand what's going on, and set the roadmap up now, because if you're waiting to, do your purchase just because the rates have gone up, you really need to set up that roadmap. You really need to understand where you're at, because there's people that are having these conversations and they're like, oh, well, I'm going to wait till January. And I'm like, well, the rates are probably going to be 1% higher, if not 2% higher by then. Is that really what you want to do? So you need to have this conversation with people that are staying engaged in the market and understand, at least, in the next couple months, what things pretty much look like, to feel like you have a grasp on what's going on, you have some control on what's going on, and to make kind of what the best decision is for you now. I just saw something came out, and I want to say it was 28,000 homes were bought last month here in California. So people are buying, right? It's not like, numbers go down, but you have to understand that we're dealing with a huge population here, right? Millions of people. So yeah, maybe it's not as much as it was, but still 28,000 purchases. I mean, that's a lot when you consider, the gist of everything. It's happening. So, if you have any questions, any concerns, or just ultimately want to start setting up that roadmap for you, reach out. Let me know. And again, this is the Hard Money Show, where we talk about real estate, home loans, and media. You guys have a good day.